Today on the show, the pleasure of speaking with Scott O'Neill. Scott is a Sydney-based real estate investor, and he retired at the age of just 28 after building a $20 million portfolio in just 10 years. Now, Scott and his wife, Mina, have now founded the commercial real estate company called Rethink Investing, a professional property investment firm that helps other Australians buy and invest in commercial real estate. And they're actually the number one buyer's agent in the country. They've helped over 1,800 clients purchase over $1 billion in Australian commercial real estate. Now, to top it all off, they're now launching their first ever book, and they want to share with the outside world their secrets about how they achieve financial freedom. And they walk through a proven 7-step method to start successfully investing in Australian commercial real estate. I'm really excited and pumped to have Scott on the show today to share his incredible knowledge about the Aussie market. G'day, Scott. How you doing today, mate?
Yeah, mate. Very good. Thanks for having me on your show.
Mate, my pleasure. Just before we get into it, I do want to preface for the show for all the listeners. They might be saying, why are we talking to an Aussie guy when this show is about investing in the US? Well, the thing is, with the American dollar being so much greater than the Aussie dollar, Scott and his company are trying to attract US investors to the Australian market. And I will just say, and we'll get into it in a little bit, I will just say there's a lot of similarities between the Aussie investing market in the commercial space and the US market. And if you can maximize that foreign currency exchange, you can come in, I think it's 1.3 times now the US dollar to Aussie dollar at the moment. So you bring $1 million in, you're shopping with a $1.3 million. So we'll get into that, but I just wanted to preface that before we dive into the show. But let's get into it. Scott, I ask all my guests that come on the show is rewind the clock and tell me how you made your first ever dollar as a kid.
It was McDonald's, actually. I was out the back filling up, basically from stockroom to the barbecue area. So I was about sort of 14 when that was happening. And got promoted to be on the actual press where you cook the Big Mac burgers and all that. So it was a horrible job, but it sort of made every other job a little bit easier, to be honest. So it was a good experience, I guess.
I tell my story. I remember being 13 and a half in Queensland and walking around the local Coolum Beach with literally pieces of torn up newspaper with my parents' phone number on it and just trying to get any job. And I remember getting Sorrento Cafe, and that was the first job. But mate, tell us about where you grew up and, your forte into the real estate market and did you have a job and a career before getting involved in real estate?
Yeah, so I was a civil engineer, so we would mostly working on railways, and then I got into sort of the building material game, so like aggregate mines, sand mines, all that kind of stuff. So very engineering focused, very numbers orientated. But what my job entailed was lots of travel, lots of after hours work, especially on the railways. You could imagine that whenever you do work on a railway, it's got to be non-peak times. So Christmas was a busy time, Easter was, even New Year's Day and things like that. We're always kind of having to, have these shutdowns. And I just thought, this is great for a few years. It was paying pretty good relatively. And I just thought I didn't want to do this for the next 40 years of my life. So it's made me look at other options, and just real estate was the obvious one. Like in Australia, there's been a really good growth pattern over the years. So if you get in early, hold for a long period of time, you tend to do very well. So that was the initial entry into it. So I just bought local in Sydney. I grew up in Sydney, and bought a little house and a granny flat. So it was like a second income on the property. And that second income actually gave the property a better yield than any other property in that suburb. So it was a positively geared property, which is quite hard to find in Australia because most properties, I guess it's more of a growth play than yield. And we just found that granny flat was the way of getting the best of both worlds, growth and yield. And that one property I paid about $480,000 for it in 2010. It's worth about 1.1 mil. So, it doubled in the 10 years after. So that was a good result. I was able to use a lot of that equity to then purchase many other properties. So we got into unit blocks. I was always chasing yield because yield was a way of kind of bringing retirement earlier. If it was simply to, I wanted 150,000 passive income at the time. And every time I was buying these types of properties, it was another 25 grand per annum, 20 here, 15 there. And it slowly added up, and we're able to replace our income. And we purchased, it was about, before we quit our jobs, it was about 28 properties we got out. And we really moved into commercial as well because of the yields were just far greater as well. So we can go into that.
Yeah, for sure. And I just want to, some of the terminology you use there, positively geared, for those American listeners, just means cash flow. and think of the big comparison I can do between the US and the Aussie market is that Australia is like LA, San Francisco, New York, high appreciation markets, low yield. So when Scott talks about Sydney doubling its value in 10 years' time, you're probably doing the same thing here in Los Angeles. Like I live in Los Angeles. You don't really find a lot of positively geared properties in LA. To do what Scott's doing, you'd have to do what he'd do here, which is, I have a 4,500 square foot lot here in LA. If I was to rent it out, it probably would not even cover my mortgage. But if I put a granny flat on the back or an ADU, like what Scott did, you can then, that becomes positively geared. And so that, cash flow, and then you can put that cash flow towards your retirement. So interesting to hear that. And my whole thing coming from Australia to America, Scott, is that I always look back at Australia and said, there can't be any yield, right? Because the big difference between Aussie and America is that the secondary markets and tertiary markets don't exist on the level that you have here in the States because of the population, right? We only got 24, 25, 26 million people on a land mass roughly the same size as America. And then America's got 300 million people, and they've got all these secondary and tertiary markets. So you can't go and find, when I first moved here, I remember seeing all this great yield in these secondary and tertiary markets outside of the LAs and the San Franciscos. Is there something similar in Australia, those secondary and tertiary markets, to get that yield in the residential to add to your 28 unit portfolio that you obviously built up and retired on?
There was maybe 5 years ago. So the growth just kept going. And this is why we moved to commercial, because we were in these regional markets. And I guess one of the big differences with Australia as well, yes, we've got a lot of land mass, but we've got very high construction costs. We've got a lot of red tape. I guess we're only building in certain areas, like probably 90% of the country you wouldn't even think about living in because it's a desert or it's just far too isolated. So although there's a lot of land mass, we're really only on the East Coast, and there's, the city of Perth in the west, and there's not much going on up north as well. So there's a huge amount of Australia that's just I wouldn't say not livable, but you wouldn't be investing there. So we are in certain pockets, and it's mostly the East Coast of Australia. That's your Sydney, Melbourne, Brisbane. They're big cities, Melbourne, Sydney, Brisbane. They're all sort of 3 to 5.5 million in people. And they're growing quick because there's just a huge amounts of people that are trying to get into this country, and they're going to be skilled migrants as well. This is the kind of post-COVID boom. Well, it's already booming at the moment, but there's another round of booming to happen once those borders open, because we're all locked up at the moment. We can't get out of the country, we can't get in. But there's pent up demand. There's 300,000 people, skilled migrants that are desperate to get here per annum, and there's a line, and they're going to move to all these capital cities, so that will contribute to more growth as well. But to answer your question, the yields really dried up in residential because of this. It's almost like a 30, 40-year pattern of growth. It's long-term, and rents just haven't kept up. But on the flip side, this is where commercial is so great. The yields, we're looking 7, 8, 9% net yields with growth as well. So the overall per annum. So very good yield, very good growth. And yeah, they're solid properties. And that's why I don't think I'll look back at residential again. It had its place for me. There was good equity gains and stuff like that. But at some point you need the yield. And that's, like how you invest, you need yield to keep going. You need to service the banks with the yield. You need yield to live off. There's no point only getting capital growth, because the only way to access that is either getting more loans or selling. And in Australia, you don't really sell because the exit costs are so high, and you've got stamp duty, capital gains tax. So you want to hold these assets. So that's one of the big differences to the sort of buy and flip methods that work in the US.
And let's try and make a comparison between the US and Australia, because part of your whole story and the book is in and around attracting the US capital, given the foreign exchange. I remember when I first moved to the United States in 2012, the Aussie dollar was actually in parity with the US, and a lot of Aussie money was coming to the US and from Europe as well, particularly buying in those cheaper secondary, tertiary markets like, I don't want to throw any cities under the bus, but like Kansas City, right? Or Detroit, all these sort of, very, very affordable cities. So now, as the shoes on their foot, the American dollar is very strong against the US dollar, the Aussie dollar. When you say commercial properties, what are you specifically talking about? Because commercial can mean such a different many things. There's storage, there's retail, there's hotels, there's multifamily. Like there's strip centers. What are you speaking of when you talk about your commercial properties in Australia?
The main things we specialize in are, like you said, storage, industrial properties. So manufacturing, it might be, the whole online boom, e-commerce boom feeds into industrial properties, especially in Australia. We're a long way from everywhere. So there's a great need for storage and logistics capabilities. So we like buying properties near airports, marine ports, medical centers. Obviously, medical is a recession-proof industry. So we like buying, general practitioner areas. You might buy the dentist. Dentists can have extremely expensive fit outs per square meter. So when you buy a good dentist, they're not going to move next door because it'll cost them too much. And they're generally not P&L, profit and loss, worried because they're doing quite well with they charge a lot and rent's sort of more insignificant for them. So we search these properties that are going to be quite strong no matter how the economy's going. And like I said before, there's a lot of red tape in Australia. So if you buy into an area that's kind of built out or there's a high cost to it, like we like buying below replacement costs as well. Yep. So that definitely just guarantees there's not going to be the threat of new supply wipe your growth out. We're going to be buying, 20% under replacement costs. So that's another kind of a safety mechanism. But like you said, we've seen a real strong increase of US investors and also from Hong Kong as well, randomly. That's obviously more political driven, but US because of the dollar, and I think it's because of how Australia's gone with the whole COVID exercise. Like our economy's been quite protected and, the government's pretty much shown they're going to just, like we're giving a large amounts of grants, similar to what the US is getting, but I think per capita it was even higher. And it pretty much just funneled all into the property market. And we're seeing the quickest growth rates in the last 33 years at the moment. So the trick is don't get too caught up with the growth because the growth will slow at some point, and that's where you need that good yield. And that's the returns are they're very impressive at the moment because of those two factors.
Yeah, right. So let's maybe walk us through a classic. I've got $10 million. I'm a US investor. I'm coming to you, Scott. I said, where do I want to put my money to go and buy? And then let's look at it from the lens of going in cap rate. What's a sort of maybe value add strategy? Because in America here, in my multifamily, I always look to try and push rents or, take it from, $900 I average on rents up to $1,200. So increasing 20 or 25% through renovations, through making, putting lipstick on a pig. Let's be honest, but doing it over 200 units because you've got the scale then, and then with compressing cap rate, I can then get that yield that you talk about. So maybe let's do it from that point of view. And where would you direct me in terms of putting my capital?
It's always budget dependent. So we work from clients with anywhere from, a $300,000 purchasing limit into the tens of millions. So it really doesn't, I guess where you want to land in that spectrum has a big impact. So we'll go in the middle.
Yep.
A recent example was we purchased this industrial facility. So it was like a logistics center. It had Amcor as a tenant. You may know them. They're a global company. It also had 4 others as well. So they're all, logistics-based type industrial properties, and they're all on long leases, 5 years. The value add here, well, number one, we bought it at an 8.21% net yield, which was better than the area. So the average cap rate for that area was about 7. So, if you divide by, I'll just get the old calculator out. If you divide 8.21 divided by the 7, we got that 17% below market value. So that's buying better than the local cap rate. So that's the first thing you want to try to do, buy below market value, because then you're having a win on the entry. And it kind of covers all your purchasing costs and whatnot. The yield being 8.21% is very strong. So obviously the cash flow was, it was very impressive in there. There was ability to increase the length of leases. So the two main easiest ways to increase value for properties in commercial is, number one, increasing the lease. So you just go find an under-rented property and buy it at the right rate. And then all you got to do is work with the tenant over a year or 2 or 3 to get them up to the market rate. And if you can bump the rents up 20%, remember commercial property, a lot of the value is associated to the rent value. So if you can increase the rents by 20%, your total equity position on the property will increase by 20%. And the good thing is valuers will recognize that. So even if you're not selling, you can literally refinance, pull that 20% difference out, and maybe recycle it into another property. So when you start doing that, you can almost get that kind of infinite return on your ever expanding deposit, because you're cycling it into bigger and bigger positions. And that's sort of what my wife and I did. We started with pretty much, it was about 50 grand at the time. That took us working in McDonald's and little jobs here or there for 5 years. We put that into that Sutherland property, that Sydney property I mentioned with the granny flat. And as it grew, we moved that into moved the equity into other high income producing assets, and it just snowballed. And the quicker it grows, the quicker you can move. And the returns will just grow, because the rents will grow on you as well each year. So the longer you hold, the better the equation gets.
I love it. And so the big thing, just recapping that, so it's an 8.1 net yield. You're really saying it's an 8.1 cap, right? You're going in and we're talking triple net lease, right? Aren't we? Where the tenant pays for everything under the sun, including taxes, I assume?
Yeah. So they'll even pay for rental management. So you imagine like like in Australia, it might be about 5% of the gross rent, which is sort of, that'd be dealing with like a major real estate company to manage your monthly statements, talk to the tenant, just basically give you the accountant-friendly statement each month, but dealing with the tenants direct. The tenants will actually pay that in many cases themselves. So, because it's all written into the lease. So it is, like you said, a triple net. Sometimes it's not, but then you just got to adjust the price to factor in those extra costs. So we always work off a net figure. Doesn't matter if it's triple net or not. We're going to calculate it back to that true net position before offering. And I guess not many people know this stuff. Compared to residential, it's just a lot less mainstream. So when you actually understand this space, you're up against less competition. Mm-hmm. That's why I like it. You can get better deals dollar for dollar, because you're not up against 200 odd other people going for the one property. You might be up against 5. And this is becoming more mainstream, which will inevitably mean there's more people doing it. But that will also increase demand. So, that's why I think that will drive down cap rates. And that's, exactly right. And that's the opportunity. For the next 5 years, cap rates will 100% have to drop down, because yields in residential are so poor. There's just so many people with a lot of money, in Australia, and a lot from overseas trying to get here, and it just doesn't justify it anymore in the residential space. So where do you go? Maybe the share market. There's not many options to get a good yield, especially in this country. But commercial is just lying there on a plate for us at the moment. And there's a time window on that. It will compress, but good numbers for now. That's incredible. And so talk about, do many of your investors or the buyers, because you work as a buyer's agent, so you represent other investors going out looking for deals. Are they looking to get out, exit at any point, or it's more of a long-term play until, they're done? Look, good question. I find, because we set up syndicates often, I find the syndicates more have a 5 to 7 year time limit. So there was one we set up and we bought in Australia's capital, which is Canberra. And, we purchased it for 6.4 mil and sold it 22 months later, because a couple of there was a divorce and a couple of those types of external factors involved. But we sold it for 8.35 mil. So it went up nearly 30% in under 2 years. And it was getting an 8% return cash flow during that time as well. So the return on equity was very strong.
Yeah.
And we thought,
what's an IRR? What was the IRR on that one? If you even,
I don't have it in front of me, but
carry the one.
Yeah, exactly. But it was to the point where, we all more than doubled our money within that very short period of time.
That's
plus
incredible.
The cash flow on top, which was sort of that rolling.
Wow.
8%.
Wow. Well, talk to me a little bit about the financing of it, because that's the big thing that you get. You talk about the 8% cash flow, and the big metric we look here in America and you look across the globe is cap rate going in versus interest rate you can get on the debt. Right. And I assume you're probably putting between 20 to 30% down on an investment property, similarly you do here. And then you're sort of financing between 60 to 80% of it at a rate of X. So what are the interest rates right now? What are the terms so you can get that juicy cash flow?
All right. So as an individual, Australian resident, you can get interest rates as low as about 2%. I've heard a few examples under that, sort of, the 1.8s for a commercial loan.
Wow.
Generally the terms have really got better in recent times. So the biggest change in the last 5 years is the loan terms. So most of my loan terms personally are 30 years. And that's generally, it's a minimum 25-year loan term at the moment. So that obviously spreads your principal out very well. It helps with servicing. So you can keep buying this stuff. If you got the deposit, the properties service themselves. So even if you get hit by a bus and there's no involvement of you, these properties will service themselves and comfortably as well. So if you're buying in a syndicate, that's where there's like a non-recourse loan. You generally work off your 50, 60% debt. So it's lower debt because there's no individual backing it. You can do things called lease docs, which is a loan without looking at your financials. So even if you're unemployed and you've got $500,000 cash, you've got to have like an Australian company or at least someone representing that company, but you can lend up to about sort of 60%, maybe even 70 in certain cases without even a job. So you just got to have access to the deposit. So another trend that's happening is lending is getting easier. They're just trying to promote growth over here, and banks are going for market share in commercial because residential, again, I wouldn't say it's risky yet, like it's not. But debt levels are higher as a percentage, and banks are looking to make money, and commercials, a nice, place they're all going to. Well, they've already been hitting it pretty hard, so we're seeing lower rates, higher lending ratios, and longer terms.
Interesting. Well, that's a great summary. And just to recap, you're saying if you're through a syndicate or syndicate, whatever you want to call it, it's between 50 and 60%, which is very moderate. And some people who listen to this show will probably think that's too low of a leverage. But there are a lot of big institutions out there that will only go here in America as well. When you buy multifamily, they'll only put 50, 60% on it. My question back to you is, if you had some principals or the managers of the company that would put their name against the loan, does that help bring that leverage up? Because that's typically how it's done here in my syndications. My business partner and I, we're saying here, we're the warm bodies, and this is what we're worth. This is our liquidity. This is our net worth, and we'll sign some bad boy carve-outs that we won't take the money and piss off to China or Mexico or somewhere like that. So can you get slightly higher leverage if you say, hey, I'm going to sign on the dotted line?
Yes, and look, it's case by case, sure. And that's the good thing. If you work with a good broker, mortgage broker, to look into the exact property and the individuals, it's a business case. So you just got to sell it. Depending on the loan size, the asset location, it varies greatly. So the trick is just to have a good mortgage broker on your side, and we can work around these things. And yes, you can get higher lending ratios, and it's just about finding that balance, which is got the best yield, because you don't want to go too risky on the property, because then the banks will punish you there. And the riskier you go, the higher the yield gets too. Generally, you probably have that in the US. You can go into the towns with less growth prospects, so they've got to make it up for yield. And my job is to find what the banks love as well, because whatever they like is a good indication. There's also strength there, and future lenders and borrowers can get easier finance for your property down the track. So it's you don't want to restrict your exit buyers as well. And so what has been the biggest biggest piece of advice you give to an American investor thinking about syndicating or putting their money into a syndication in Australia? I know I attract a lot of money from Australia into the US, and we go through
our LLC agreements, we have PPMs, so it sort of is a disclosure saying you are getting involved in a risky deal. How would a US investor do the same coming back the other way? Are there the same documentation involved to protect them in a worst case scenario?
Yeah, look, it's just about having the right set of teams around it. So you have an accountant that specializes in this space. So you're protecting yourself. Generally, a company is the best setup to protect you, because you can retain profits in the company and pay dividends, and you can play around. It's better from a tax point of view that way. And you also can redistribute the profits into other properties. So like I said before, you don't have to just finish with the one. You might wait for that to go up, and then you basically expand it into a future purchase. But I honestly think it's the same as a purchase if you're local. You've got to just really, we're not big in taking risks. Like that's the engineering side of me. Like we're all about looking at the worst case scenario with the asset. What happens if the tenants leave? How quickly would it take to replace that tenant? You just want to be overly cautious, particularly because it's the other side of the world. But you guys have different advantages because, like you said, there's a massive advantage with the currency at the moment. Your dollar goes far. And right now, I think our real estate is quite undervalued, specifically the commercial side. So just having the right setup, you've got to have a good mortgage broker that understands your position. You're making an income somewhere else. So, so does that get recognised by Australian banks? If not, what other options do you have for lending? So working out the lending scenario for your individual case is important. And then, just having those trusted people on the ground will make it quite easy to deal with. It's just the time zone difference after that.
Yep, that's exactly how my Aussie investors and international investors deal with me. So they build that trust. They understand the operators who are boots on the ground, who are doing the deals and finding the great deals day in, day out. And seeing a track record is also obviously really, really important. And then talking to other investors about referrals and saying, how have you successfully exited? Have you successfully exited with this particular operator? Now, exactly the same sort of stuff. I think on the legal side, there'd be probably a bit more questions that you could get a lawyer involved in terms of how you sign up and stuff. But tell me, I know we were speaking a little bit before this podcast about the lack of, I don't want to say sophistication, but you're essentially in the brokerage space, right? You're out there shaking the tree to see what fruit falls off. And then there maybe isn't as much software on the commercial side as they have here in the US. I'm thinking about the CoStars, the Asymmetrics, all the big players that bring out market data every year. So how is it a little bit not as advanced in that state in the commercial area, in the commercial space in Australia?
It's a good question because there's plenty of coverage on residential. Like in Australia, it's the barbecue topic. Everyone has a strong opinion on residential real estate, whether it's going up, down, sideways. It's part of our culture. It's enormous. But commercial, no one knows about it. It's just out of sight, out of mind. Yet you drive up and down the street and you're seeing big factories, all the big international brands. Like it's just out of reach and out of interest for many. But that's changing. But one of the reasons is media coverage is very low. Data coverage is very low. How I get my data, it's manual. I've got a team and we actually have to understand the individual markets that we're investing in. Like how long was that exact property vacant for? How many vacant are within 50 kilometers of this area or miles? It's so hard to get that manually. And that's probably it helps me as a company because we understand this from coast to coast. So we've got good context between cities. We can identify sort of undervalued pockets or more importantly, where the market's starting to turn. We're on the coalface. We can see there's more buyer activity just starting, or maybe the leasing periods just dropped from 3 months vacancies to 2 months. And that's a sign that rent growth is going to happen. As the rent growth happens, so will your asset appreciation down the track. Unfortunately, this is not documented. It's generally, you just know small pockets, and the major real estate companies spit out their own results, but it's more just company related. The likes of Savills or Knight Franks, they're all over the world. You get their reports, but they're only talking about very high level properties. Generally the big stuff, the 50 million and above. They don't talk about what most people actually want to buy, which is, your $1 to $5 to $10 million smaller properties, because that's what most people can afford. So that's our pocket space. We specialize in that that level, because I find the yields are actually better than the $50 million assets as well, because you're not up against institutions and managed funds, because they push yields down because there's more competition at the higher level.
Yeah, there definitely is, but there's also a little bit that they're a bit of a slower moving beast, and we've started to delve into the bigger stuff here in personally, and we found that where the value can be created when you're buying from institutions is that they just don't have the attention to detail on the small stuff, like probably your lease contracts, like negotiating a good contract so you can add that value, or adding value in a way that they didn't think about, and because they've got 40, 50, 100 assets in their portfolio, they're not worried about that little one that you could squeeze a little bit more juice out of. So it can be good and bad, right? And it just depends on how you go and create your value in the specific niche or in a specific area, right? Because every deal's different, and you have to look at it through a certain lens. No, I love it. Tell me a little bit about how you're creating the company and the brand, because what I would naturally go to, if you're already creating these syndicates and you're already looking for deals for other investors, why go to the other investors? Why don't you keep them for yourself? You're trying to find the money and the equity. Is that the hard part?
Look, so we're purchasing about, it's on average about 25 properties a month. So there's no chance we could ever do this ourselves. And look, at the same time, my wife and I have got a large portfolio to the point where it's a bit of a hassle. So we're actually trying to sell off some of our smaller assets and probably just concentrate on good quality, larger ones, because that's what I've learned. That's just my personal preference. It's what I want to hold until I'm a little old man type of thing. I don't want to be dealing with individual houses, individual tenant problems, because there's lots of them. Every time there's bad weather, right? You got to repair stuff, and it's never ending. But when you've got a good commercial property with a triple net lease, maintenance is on them, insurance is on them. You're generally dealing with 5 to 7 year leases rather than 12-month leases, so the turnover's less. I like dealing with a professional tenant because they got their own brand and reputation to uphold, so they perform like a business should. When you're dealing with individual tenants, you just got 1,000 factors that are going to just work against you. So, we concentrate on working with the business. The more we help our clients purchase, the better our networks become. So that's probably our biggest strength. It's who we know in the industry. It's like any industry. We know lots of good agents and people selling direct. And they send us properties before they hit the market. So it's probably like what you do there. You get your best deals pre-market, where no one else gets to see them, and we're just negotiating versus the owner. Now, we still buy properties when they are online, but we're acting very quick. We're a little bit more nimble than others that, like you said, the big managed funds, they're going to take an extra month to get their stuff together. But before that, you're already in there and got control of the asset. So very similar models, but our niche is just getting off-market stock and doing all the due diligence for the client. We've got a due diligence team which will go through every single number on the property. We call the tenants up, get their business plans. We just want to know their intention. We look into the competitor analysis, make sure there's no extra, if you're buying a fast food restaurant, make sure there's not another DA down the road going up, to build another one. And it's just a very holistic approach. And if the property stacks up and looks good, we proceed to settlement on it.
Awesome. And do you ever combine, and I don't know if this ever occurs, but I know an Australian investor, he was KP on my deals. We were still going to get him on the show. On my early deals, he came out to America, made a bunch of money in multifamily and took it back to Australia. And he's actually buying medical office buildings or medical office businesses, so doctors, essentially, practices, but trying to team them up with actually getting the dirt as well. Do you ever see that where you're trying to buy the business on top of the dirt rather than just the dirt and be the triple net lease?
Yes, it's happening more commonly. Like it's, you just got to be, you want to be in the right business, I guess.
Sure.
So it's very common with things like car washes in Australia where you buy the business because those car washes are very passive. Generally, my investors are passive investors. They're happy to sort of do a bit of a value add here or there on the property, but they don't want to manage a business because it's a whole different ball game. So doctors are very specialist. So if you're a doctor investor, that makes sense. You can pretty much get the practice up to a normal level, create some goodwill in that, sell the business for a higher amount to someone else and they can take it over. So that's a double play, but it's a fairly low percentage play too. There's just not many of those opportunities that come up. And if you're in the right industry, then yeah, go for it. But I personally wouldn't try and improve a medical practice because I'm not a doctor. So,
well, he's done it. He's doing it really, really well and making an absolute killing on it as well. So it's just these weird things that you need to do. Like you spoke about medical office centers and being around that, and then having a facility or near a medical office facility so you can be the storage for that, or something that is going to be an ancillary service to a major job creation in a specific market is really, really important. Yeah. So, no, awesome stuff, mate. Tell me a little bit about the book, because you're about to launch it. We've got you on the show. We want to hear about your book and what you're coming out with. You and your wife co-wrote it, right? What's in it?
Yeah. So when I started getting into commercial property, it took me about 18 months before researching to actually buy a property. And I remember reading as much as I could. And it was funny, there was probably more stuff in the US at the time about commercial property than Australia. There was nothing about this market at the time. There was no commercial books. Even when you Googled commercial investing in Australia, you just would see some very half-cut residential based investor talking about it on the side. And it was just very poor information. So it was very hard to learn about. And I just wanted the basics, what's the difference between, industrial to medical to office space, specialty, childcares and service stations. It was very hard to sort of compare things and learn about it. So this book basically covers all that. It's just it's a basic run through of everything about real estate in the country. But it's using real life examples, like how my wife, Mina, and I actually got into property, how we transitioned from residential to commercial, and how the numbers were just so much better. And we compare sort of, there's lots of spreadsheets and all that kind of stuff in there, just showing the different returns on equity. And it's just a one-on-one summary of the book. And it's going quite well. There's about 2,000 copies that sold last week. So
beautiful.
Going pretty quick. So we're happy with that. But it's just, we just want to get commercial more mainstream in Australia. That's sort of our goal, because it feels good to do something new in the country that hasn't really been covered properly. So that's sort of what we'll be doing.
That's awesome. And I think there's just an incredible opportunity if you can add the technology piece to it, to capturing that data in a more systematic way, and then selling that data back to the industry. Yes. You'll be attracting a lot of big players, because it's like I literally just did a podcast about mining. It was not about the gold that you dig for. It's about the person who sold the shovels and the ropes and the buckets that made all the money. And if you can capture that data and it's an additional vertical income, it makes sense, because people do yearn data to make educated decisions about their investment portfolio. So awesome stuff, mate. I'm really excited for you, and can't wait to read the book and get my hands on it so I can learn a little bit more about the Aussie real estate market. Mate, at the end of every show, we like to dive into the top 5 investing tips. It's a quick 5-question lightning round. You ready to get into it?
Sounds good.
Mate, what is your daily habit you practice to keep on track towards your goals?
It's basically routine. So I like to exercise every day, whether it's surfing or just a quick gym session. It clears the head, because I work quite late hours. If you don't have that break, I find you go a bit mad, to be honest. It's like digits and never-ending phone calls, and it will get repetitive at some point. So having a routine, whatever that is very important to stay focused.
Oh, 100%, mate. It's nearly 4:00 here, and I blinked and the day's over. I can't even believe. Question number 2 is, who's the most influential person in your career to date?
Oh, good question. Look, it's probably my father, because it'll sound weird, but he was so negative on every business opportunity. And it made me look at, it's funny, you go up down the street and go, yeah, that business is not going to work, or that really, I guess, skeptical kind of view of looking at things, I think made me a good investor, because I never went with rose-colored glasses into an investment. I always expected things to be not perfect, and then how to deal with that. So I was always sort of programmed to think that, because of his negativity towards all sorts of things, be in a good way. I don't mean it as saying everything was terrible. It was just more, look at things deeper. Don't think it's always going to be, perfect, because it won't. And then if you could deal with that non-perfect situation, then it may be a good investment or opportunity or whatever we're talking about.
Awesome. Love it, mate. Question number 3 is, in your business, what's the most influential tool? And when I say tool, it could be a phone or a journal, or it could be a piece of software. What is it?
Oh, look, it's probably not something individual. It's more just our contacts, I guess. So, you could call that the phone, but it's over the years, because we've been doing this, at fairly high volumes for many years. That's our great IP. Agents and people selling properties know who we are, so they come to us with the deals, and that is gold. It means we can bring good deals to our investors, and even if we didn't even try, they're going to be landing in our inbox every day, and that's
great.
Taken years to get to. So that's the number one for sure.
That's great. Well done, mate. It's definitely carving out a niche in an industry that is being not neglected, but maybe not spoken about as much. So well done. In one sentence, what's been the biggest, and I say the word failure, but it's more mistake. What's the biggest mistake / failure you have had in your career? And what did you learn from that?
Look, it's going to sound cliche, but probably just not getting into it a bit sooner. I was going down the path, because I was very cash flow focused, and I always knew about commercial, but I got spoken out about it by my mortgage broker, by, my friends and family at the time when I was younger. And I always knew this was where it was at. And it was just, I focused on the risk way more than I needed to, rather than going, how do we deal with that risk? And I could have got into it 5 years earlier, and I don't regret anything. But yeah, obviously, I love this whole side of the investment world, and I just delayed it for no good reason, really, because I was following what everyone else wanted to do.
Yeah, exactly. Following the poor dad mentality of what people thought was too scary, the boogeyman, 100%. Right? Awesome stuff, mate. Last question is, where can people reach you to continue the conversation? They want to be in your sphere. Where do they go?
Best way is just Google Rethink Investing. You'll see us all over the internet, and we've got phone numbers, but emails. So info@rethinkinvesting.com.au. And we'll get back to you within 24 hours.
Awesome stuff, mate. Well, look, I want to thank you so much for jumping on the show today. I was really excited to talk to you about the booming industry of commercial real estate in Australia, just how the lack of coverage it's got. And I think you've done an incredible job, you and your wife, taking a niche and making it more understandable, breaking it down into its parts so people can get involved in it through your own personal anecdotes and experience. I think that's super, super helpful and valuable to be sharing that with the outside world. And then also for Americans who are looking to invest into Australia, using the good foreign exchange currency, and then understanding that there's people like yourself and companies out there that are doing syndications in Australia in the commercial space, getting some really good attractive financing on the upfront purchase, coming in with good cap rates, understanding the value can be created, and then exiting at a profit. I think I will be able to definitely send you some investors along the way. But did I miss anything out in that recap?
No, that was perfect, mate. I like the summary.
Awesome stuff, mate. Well, look, I want to thank you again for taking some time out of your day. Enjoy the rest of your week, and we'll catch up very, very soon.
Thanks, Reed. See you, mate.
Well, there you have another cracking episode jam-packed with some incredible advice from Scott. Please definitely head over to rethinkinvesting.com.au. I hope I got that right. It's also Rethink Property Investment on Google. Info@Rethink Investing, I believe it is .com.au. And if you have any questions for Scott, please go over there and check him out. Google him, understand what he does, because he is doing some incredible stuff in the Australian real estate, commercial real estate market, which can be very parallel to what we do here in America. So definitely check him out if you're looking for that yield, because I know here in America, it's becoming harder and harder to chase. I want to thank you all again for taking some time out of your day to tune in to continue to grow your financial IQ. If you do like this show, the easiest way to give back is to give it a 5-star review on iTunes. And we're going to do it all again next week. So remember, be bold, be brave, and go give life a crack.